that, I'd like to welcome Andrew Dickey from JLL, okay?
Thank you. Medelhan, Ricardo, Lucia, thank you for hosting us. Lucia told me I had 10 minutes to talk about the global luxury hotel market. That's pretty, in 10 minutes, it's pretty tight. And with the market down 400 points, it's been a rough day. I'm gonna start with the bad news, and then we'll finish with, very American style while we're here with some good news. The global hotel market is dynamic, right? We have, the beauty of hospitality is our rate changes every night. We're not an office building, we're not retail. We can't rent for a year, 5 years, 10 years. So the good news is with inflation, which changes all the time, we get to change our rate every night. So it's dynamic pricing. It also makes it the most risky asset class, right? The minute a 9/11 happens, as 2020 COVID, no one travels, the hotels have hundreds of employees, we lose money right away. So on that side, we have an emotional asset class, probably the most emotional asset class after residential. Nothing against our industrial folks and multifamily or office buildings, but they're less emotional. It's more cap rate driven. Hotels, particularly in the luxury space, are more emotionally driven. So we'll look at the pressures today. So you read the news, okay, real estate crisis in China. You'll read the headlines from the Wall Street Journal today. Are we going to test China's real estate market too big to fail? It's one of the largest luxury hotel markets in the world. We talk about inflation. Here in the US, we talk about, it's dynamic pricing, student loans. They started to get payment this month. The largest travelers in the world now are millennials, which is also the largest population. They passed the baby boomers as the largest population in the world. Now they also travel way more than anyone else in history. So we have a lot of headline news, not all bad, but it's tricky. Now in the luxury space, the beauty of the luxury space is that we are we're way ahead of it, right? If you think about it, we're hedged. Because in the luxury space, 70% of luxury travel is high net worth individuals. That segment, inflation or not, trouble in China, Asia, India, the US, they still travel, right? It's a matter of being a unique segment. And this is 2023, first half of the year, and it's US data because the US is the most liquid hospitality market in the world, right? We trade hotels like cars. We're down to 2010 levels in terms of transaction volume. So for the first half of the year, very rough. And you see it here as well, the deal size, about half of where we were 2 years ago. So you're looking at transactions, you're saying, okay, the value of a hotel per key is almost half where we are today than where we were less than 2 years ago. Who's buying hotels, right? Right now it's private equity. And I would tell you in the last 6 months, 9 months, it's high net worth families, individuals who are looking past short-term buying. They're looking, 10 years, 15 years, assets to hold forever. And then of course the luxury and select service is in demand. Why is that? So select service are hotels, right, without food and beverage. Their ticket size tends to be very small, sub $30 million. And so you can buy a bunch of them and it feels like a diversified portfolio versus, going all in on a $200, $300 million asset. Then again, since the high net worths have made more money post 2020 than they ever have, they're also buying long-term. So here's the good news. It's a little doom and gloom when you get into prices at, things being half off in the last 2 years. Here's the good news. If you look worldwide, luxury travel is at all new heights. And luxury market, and I think this is a key one, and this gets into where we're gonna get into more residential part of it. luxury hotels have become more of a larger share of total hotel volume in the world. So historically, we've been around 4 or 5%. Luxury hotels, of total hotels in the world, 4 or 5% have been luxury. Today, we're closer to 6 to 7%. And a lot of that is because of condo and residential. If you look here in downtown Miami as an example, we say anything that can go condo will go condo, right? There's how many buildings here out front, they said, hey, we would love to do a hotel. My response is, no, you don't, right? Because if you look at your return metrics, it takes you much longer to make your returns on a hotel than condominium. And if you're gonna build condominium, there's a little trade-off. They're also looking for brands, right? Partner with a luxury lifestyle brand that everyone knows, help sell the residential. Each brand has their metric. Hey, we can sell more per square foot than you would as an independently non-branded residential project. And so as a result, we're seeing the growth in luxury supply, not necessarily of standalone hotels or resorts, but a lot of that's urban. A lot of that is condominium projects, really driving hotel development on the luxury space. Not to mention any names here, but if we look, we use Miami as an example because we're here. We've worked in a handful of luxury hotels where the developer will build it, make X on the residential component, maybe lose 20% on the hotel component when we sell it, right? And that was a good day because, hey, it was a loss leader to offset the residential sales. So I think globally, we're seeing high net worth value increase. We're seeing more luxury supply than we ever have, all the way back to 1983. And despite all the headwinds, economic, inflation, it all bodes well for the luxury hotel space. Thank you.